You ready? Okay. The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is titled Lender of Last Resort, Issues with the Fed Discount Window and Emergency Lending. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. In performing lender of last resort functions, central banks have long been told to abide by recommendations memorialized by British journalist Walter Bagehot in the late 1870s. Bagehot advised that in panics and times of unusual liquidity needs, central banks should lend freely at a penalty interest rate to solvent borrowers who post good collateral. Following the speed of the bank runs last March, perhaps lending freely also means that the Fed should be prepared to lend quickly on good collateral. There are 2 main ways in which the Fed performs its lender of last resort function. One is by lending to financial institutions at the Fed's discount window against good collateral to solvent borrowers. Another is by using lending authority in Section 13.3 of the Federal Reserve Act to make emergency loans in unusual and exigent circumstances. Among other things, today we will explore the difference between the discount lending and emergency 13.3 lending, whether we are to rely on the Fed too much in times of stress, and the issue of stigma that banks face in accessing the discount window. The recent history of increasing Fed intervention into private markets traces back to the financial crisis in 2008. At that time, the Fed used its emergency powers to lend to save individual companies that were teetering on the brink of failure, such as Bear Stearns and AIG. Those actions proved unpopular, as the Fed appeared to be propping up individual companies and potentially exposing innocent taxpayers to private sector losses. In partial response, the Fed's emergency lending authority was amended in the Dodd-Frank Act to provide greater clarity on liquidity requirements, more transparency in Fed emergency lending, and approval of the Treasury Secretary. Emergency lending was also changed to try to prevent the Fed from acting to save an individual firm by requiring that emergency lending must be undertaken in a broad-based program to provide support for more than just one single firm. Next, in 2019, in the face of liquidity shortages and volatility in money markets, including markets for Treasury securities, the Fed intervened using repo facilities that were eventually made permanent. Following that, on the onset of the pandemic, the Fed intervened further in markets. The CARES Act provided backstop funding at the Treasury to help the Fed use its 13.3 authorities to massively expand its reach, lending far and wide as Congress instructed. Most recently, the Fed set up a new lending facility called the Bank Term Funding Program in response to the March 2023 bank failures and interest rate risks facing financial institutions. Following the bank failures, the Fed has reportedly been working to re-examine operations of its discount window, given that operations appeared, as Chair Powell has stated, clunky. Part of that re-examination involves the role played by federal home loan bank loans in the provision of liquidity to banks, which we can discuss today, though I am skeptical that home loan banks were integral to the Fed's emergency lending clunkiness last March. As the Fed re-examines its operations, an open question is whether legislation may be needed to address some of the problems in the Fed's liquidity provision present last March. Meanwhile, federal banking agencies appear to be examining new liquidity rules for financial institutions, some of which could have implications for markets for Treasury securities. Let's hope that the Fed does better at analyzing such things than it did with its underanalyzed recent Basel Bank capital proposal. I thank our witnesses for appearing today and look forward to hearing their views on all of these important issues. The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Dr. Foster, for 4 minutes for an opening statement.
Thank you, Chairman Barr, and to our witnesses today. When the Federal Reserve was created in 1913, one of its core roles was to serve as a lender of last resort, providing emergency liquidity to banks during times of financial stress. And since then, the Fed's role as an emergency liquidity provider has evolved. The Great Depression led Congress to grant the Federal Reserve authority to provide liquidity to firms, quote, in in, quote, exceptional and exigent circumstances under Section 13.3 of the Federal Reserve Act. These authorities were ultimately narrowed, and safeguards were placed by the Dodd-Frank Act following the 2008 financial crisis, when the Fed made targeted and controversial loans to individual firms like Bear Stearns and AIG. The Depression also spurred the creation of the Federal Home Loan Bank System, which developed over the years to become an important liquidity tool for banks, credit unions, insurance companies, and CDFIs. It also provided key competitive advantages due to the smaller institutions that they serve. And this, I believe, is one of the things where there's strong bipartisan concern about maintaining a healthy size distribution in banks. I know that from my time starting a small business and watching it grow, it's hard for small businesses to get the attention of very many banks for the small amount of business they have. And it is a huge advantage for small businesses to have a variety of institutions of different sizes bidding for their business. That won't happen if the natural forces, as banks become more digital, cause them to consolidate more and more. And so having institutions like the Federal Home Loan Bank System that level the playing field to some extent between the larger and smaller institutions is another key role that we shouldn't overlook. In this hearing, we're going to be discussing how the Fed's discount window and other emergency lending authorities have performed during recent economic shocks, and the stigma associated with the use of the discount window and the interplay between the Fed's liquidity tools and the other government lending programs, like those operated by the home loan banks and the NCUA's central liquidity facility. As we saw with the regional bank failures last spring, social media and the 24-hour banking have the potential to accelerate bank runs by facilitating the rapid deposit withdrawals and exacerbating shifts in market behavior. I'm afraid we're soon going to be living in a world where individuals' artificial intelligence financial advisors on their phones will be continuously monitoring social media buzz, seeing if the bank at which you have your deposits looks like it's rumored to be getting in trouble and pulling your money automatically. So we're talking about something that won't proceed at the speed of social media, but at the speed of artificial intelligence. And we have to make sure that we have some defense against this, which is not so much pre-positioned capital, but pre-positioned capital flight, which is what I'm afraid we're going to see when everyone's got their financial advisors automated, or at least enough people to really put banks at risk. And then there's the whole separate issue of short sellers and deliberate attacks on a bank. When banks depend so much on their reputation, and if a deliberate attack is made on a bank's reputation for illegitimate reasons, which is not a rare thing to happen on social media, we have to make sure that there's a defense for well-run banks against this kind of attack. We saw probably the first big example of this when Silicon Valley Bank's depositors were spooked by announcements that the bank was seeking additional capital. Just saw the thing amplified on social media and the whole thing take off. Anyway, and we also saw just an incredible rate of capital flight, $42 billion within 24 hours. We've never seen anything like that, and it's only going to get worse. So this is an important hearing. I want to thank our witnesses and our chairman for convening today.
Thank you, Dr. Foster. And finally, the chair recognizes the ranking member of the committee, the gentlewoman from California, Ms. Waters, for 1 minute.
Thank you very much. It has been nearly a year since we faced the sudden failures of Silicon Valley Bank, Signature Bank, and First Republic Bank. I was pleased Treasury Secretary Yellen, the Federal Reserve, and FDIC took swift action to stabilize the situation. Going forward, I support efforts by Biden's regulators to encourage the use of the Fed's discount window by banks that need liquidity. I also support FHFA's work to ensure federal home loan banks use their advances to support housing and community development instead of propping up failing banks. Last, I hope we can act on my bill to address NCUA's bipartisan request to give small credit unions access to emergency liquidity through the Central Liquidity Facility, as we did during the pandemic. So I look forward to hearing the witness testimony, these issues, and I yield back.
Thank you. Today, we welcome the testimony of Professor Hal Scott. Mr. Scott is the Nomura Professor of International Financial Systems at Harvard University. Mr. William Nelson. Mr. Nelson is Executive Vice President and Chief Economist at the Bank Policy Institute. And Professor Simon Johnson. Mr. Simon is the Ronald A. Kurtz Professor of Entrepreneurship at MIT Sloan School of Management. We thank each of you for your time and being here today. We would ask each of you, after being recognized for your 5 minutes, to give an oral presentation of your testimony, and without objection, each of your written statements will be made part of the record. Professor Scott, you are now recognized for 5 minutes for your oral remarks.
Thank you, Chairman Barr, Ranking Member Foster, and members of this subcommittee for inviting me to testify before you today on this topic of lender of last resort. My testimony is my own and does not necessarily reflect the views of the Committee on Capital Markets Regulation or its members. The Fed's lender of last resort function is of critical importance to the U.S. financial system. It needs reform to better respond to today's financial panics. Here are my recommendations. First, the Fed needs to clarify its collateral policies. Under the discount window, the Fed need only have collateral to its own satisfaction. After SVB failed, the Fed established the Bank Term Funding Program under Section 13.3 of the Federal Reserve Act and valued hold-to-maturity government securities at par rather than at market as they had done under the discount window. Why didn't the Fed make this adjustment under the discount window before SVB failed, as it had the power to do so? So it needs to, I think, clarify its collateral policies, particularly in crisis. Second, operational improvements to lender of last resort are necessary. The failure to extend the operating hours of FedWire on March 9th to allow SVB to borrow from the Fed contributed to SVB's failure. Recent proposals have suggested that banks pre-position collateral at the Fed in sufficient amount to cover their runnable liabilities. A more workable and perhaps less costly approach would be to design a system by which collateral and funds can be instantly transferred at the push of a button. Third, acting as lender of last resort should be the responsibility of the Fed alone. I do not think the federal loan banks should have this role as lender of last resort. Fourth, lender of last resort facilities just for banks should occur through the discount window and not under Section 13.3. Whereas discount window lending is within the sole discretion of the Fed, Section 13.3 lending requires Treasury approval. To my knowledge, the 2023 crisis was the first time Section 13.3 has been used to create a lending facility just for banks. This facility was not needed to value government securities collateral at par. This could have been done under the discount window. It was not necessary to avoid stigma. Stigma potentially comes from borrowing from any lender of last resort facility. The Fed may be seeking to pull back from acting as lender of last resort on its own under the discount window, seeking cover from the Treasury approval required under Section 13.3. But the Fed needs to maintain its independence as a liquidity provider, given its clear mandate under Section 10b to act independently. Fifth, the respective roles of lender of last resort and deposit insurance in stemming contagion must be re-examined. In the 2023 crisis, the Treasury invoked the systemic risk exception to protect the uninsured depositors of SVB and Signature when they were already in receivership. Due to Dodd-Frank, this power can only be used for banks in receivership. It can no longer be used to protect all depositors to the banking system without a joint resolution of Congress, which I regard under these circumstances as impractical. Congress should consider restoring the ability to increase deposit assurance in a crisis, and it should also consider increasing the general limits for accounts that present greater run risks, and cannot be managed to the current 250,000 limit, such as business payments. Sixth, under, and I stress this, appropriate circumstances, executive compensation should be clawed back if a bank has received lender of last resort funding from the Fed or has imposed costs on the FDIC or the government more generally. Seventh, the Fed's emergency lending facilities, and this is a lesson from COVID, should be limited to liquidity provision and not entail fiscal policy, which results when there is substantial credit risk to the Fed, as was the case with lending to small businesses, non-financial firms, under COVID's Main Street Lending program and other facilities that the Fed designed. In summary, we need to reform the lender of last resort role of the Federal Reserve to better deal with financial panics. Thank you again for inviting me.
Thank you. Now, Mr. Nelson, you're recognized for 5 minutes for your oral testimony.
Chairman Barr, Ranking Member Foster, and members of the subcommittee, thank you for the opportunity to testify today. My name is Bill Nelson, and I am the Chief Economist of the Bank Policy Institute. Prior to joining BPI, I was a Deputy Director of the Division of Monetary Affairs at the Federal Reserve Board, where I helped develop the Fed's discount window policy and oversaw the lending operations of the 12 Federal Reserve banks, including regular discount window lending to banks and emergency lending to non-banks. The Fed extends discount window loans as collateralized advances under the authority granted under Section 10B of the Federal Reserve Act. The loans can generally be extended for maturities of up to 4 months and must be secured to the satisfaction of the lending reserve bank. Most discount window collateral is pre-positioned at a Federal Reserve Bank, and 80% of that collateral is loans to businesses and households. Most central bank lending to banks is unremarkable. Prior to the global financial crisis, discount window lending was an important tool for monetary policy implementation. If the Fed inadvertently left the system short of reserves on any given day, the Fed funds rate would rise up until some bank borrowed, creating more reserves. Smaller banks borrowed to address short-term funding needs, such as might be caused by losing a large municipal deposit, for example. To be sure, the discount window is also and has always been the Fed's first line of defense against broader financial turmoil. In part because of the dual nature of discount window lending, both unremarkable monetary policy tool and source of contingency funding, there has been a stigma associated with borrowing from the discount window at least since the 1920s. Tapping your contingency funding inevitably suggests something has gone wrong. Stigma got much, much worse in the aftermath of the global financial crisis when borrowing from the discount window was conflated with having received a bailout, even though the loans were fully collateralized, extended at an above-market rate, and all repaid on time with interest. Because of the pillaring banks that borrowed received, many banks now refuse to borrow under any circumstances except perhaps an obvious glitch affecting the entire payment system. Consequently, one of the Fed's most important monetary policy and financial stability tools doesn't work well. Another source of stigma is that the post-GFC liquidity requirements do not recognize access to the discount window and pre-positioned collateral as a source of liquidity. Banks are not allowed to assume that they borrow from the discount window in either the liquidity coverage ratio or their internal liquidity stress tests. Not only do these restrictions depart from reality, a bank prepared to use the window is more liquid than one that isn't. They miss an opportunity to create a strong incentive for banks to be so prepared. Moreover, efforts by the banking agencies to convince banks that they should be willing to borrow from the discount window ring hollow if banks are told that contemplating such borrowing is verboten when the banks test their liquidity needs under stress. In the wake of the bank failures in spring 2023, there has been an increased recognition of the importance for liquidity risk management of being prepared to borrow from the discount window. There appear to be several different approaches floating around for encouraging such readiness, but all involve requiring banks to have discount window borrowing capacity that, when combined with deposits at the Fed, exceeds some proxy for short-term funding needs under stress. A common thread across the proposals is a recognition that a bank that is prepared to borrow from the discount window is more liquid than one that isn't. and that weaving that thread into the weft of regulatory and supervisory assessments of bank liquidity will make those assessments more accurate and increase incentive for banks to be prepared to borrow. A critical ingredient of any such new requirement is reducing discount window stigma. While there is no easy way to reduce discount window stigma, as a first step, the leadership of the Fed and other banking agencies need to educate the public, Congress, bank examiners, and bank investors that borrowing from the discount window is a business decision of the borrowing bank and neither a bailout nor an indication that the bank is in trouble. Any requirement that banks maintain minimum amounts of discount window borrowing capacity would, of course, need to go through a notice and comment process. In this case, given the novelty, importance, and systemic implications of any such requirement, a better approach would be through an advance notice of proposed rulemaking, which would allow the agencies to receive input on the general idea from bankers, central bankers, academics, and other stakeholders before drafting a specific rule. Thank you. I'd be happy to answer any questions.
Professor Johnson, you're now recognized.
Thank you, Mr. Chairman. I would like to make 3 points. The first, in making the first point, I'd like to read 2 statements or 2 quotes for the record. The first, and the quote begins, "Silicon Valley Bank, like our mid-sized bank peers, does not present systemic risks," end quote. That's a statement that Greg Becker, the CEO of Silicon Valley Bank, submitted to the Senate Banking Committee for their hearing on March 24th, 2015. The second quote is from a joint statement by the Department of the Treasury, the Federal Reserve, and the FDIC on March 12th, 2023, which reads, "We are also announcing, in addition to what they're doing for Silicon Valley Bank, a similar systemic risk exception for Signature Bank, New York, which was closed today by its state chartering authority. All depositors of this institution will be made whole." Now, the total assets of Silicon Valley Bank, as I'm sure you know, Mr. Chairman, when it failed was something slightly above $200 billion, and Signature Bank was about $100 billion. So while we have been discussing many of these issues for a long time among ourselves and with you and your colleagues, I think we have learned over the past 10 or 15 years that this category of banks around 100 billion or slightly above 100 billion can indeed pose systemic risks. I think Mr. Becker, unfortunately, in 2015 was not correct in his statement. My second point is, I think, a combination, actually, of what you said at the beginning, Mr. Chairman, and what Dr. Foster said, which is, I think there's 3 issues bundled together as we discuss the Fed discount window. The first is it clunky? And the answer is absolutely yes. You're quite right. And I think Professor Scott and Dr. Nelson have both got proposals to make it less clunky, and I think we just need to find technically the better solution. Maybe we have a couple of them and have the Fed try them out. The second issue is the stigma. And this is something Dr. Nelson has spent a long time working on. I completely agree that we should press on these dimensions. It is a very hard problem to overcome because, as you know, Mr. Chairman, within banking, this signaling virtue is done in various ways, and one of them is staying further away from anything that could look like, on a regular basis, being emergency lending. Now, if, of course, there's a systemic crisis and the Fed says, we're invoking 13.3, we'll lend to you on very advantageous terms, that removes the stigma, that encourages people to come in. That was the dynamic of 2023. Very hard to overcome that. But I would like to overlay on this and emphasize what Dr. Foster said, which is the speed of these runs is only going to accelerate. And I think Dr. Foster's world with the AI advisors is not an imaginary or futuristic world at all. I think that world, we already live in that world. Having those advisors speed up the bank runs will be coming for sure. And so in addition to dealing with the clunkiness and removing or attempting to address the stigma, I do urge consideration of revisiting the transaction account guarantee program, which previously, before Dodd-Frank, could be put in place by a 2/3 majority of the FDIC board with the agreement of the Treasury Secretary consulting with the President. After Dodd-Frank, as you know, it's locked up and requires congressional approval, and there is specifically a fast-track process for approval of the tag through the Senate, but not through the House. And I've not yet found someone who could explain to me why there's that differential. I think at least a fast-track process in the House to match the one in the Senate would be helpful. But I actually think that putting the ability to invoke the tag back into the hands of the executive branch, the FDIC, the Fed could certainly be involved, and the Treasury Secretary, I think that would be wise as a complement to all the other measures that you're considering. The third point that I want to make is a little more awkward, and I'm sorry that I need to bring this up, but you mentioned Bear Stearns, Mr. Chairman, and I think that is a good parallel and an important historical example. And I'm sure you and others will remember that at the time the Fed provided support to the transaction, which was the purchase, ultimately JP Morgan Chase was able to buy Bear Stearns. A senior executive of JP Morgan Chase was on the board of the New York Fed, and the New York Fed was instrumental in designing and implementing that transaction. Now, I understand that the governance within the Federal Reserve System is complicated. We can talk about that. I know the Board of Governors ultimately has overriding authority, and I know that's true particularly with regard to bank supervision, but it is a very unfortunate fact that Mr. Becker, whom I previously mentioned, who was still the CEO of Silicon Valley Bank in March 2023, was sitting on the board of the San Francisco Fed. This doesn't look good. It may just be an optics problem, but it really doesn't look good. It's not good for the Fed, and it's not good for any of these technical fixes or any of the other, all the political support they need to remove the stigma problem, for example. So I understand Dodd-Frank attempted to address this. I know steps were taken. I understand the difference between Class A and B and C directors of Federal Reserve banks, but I really think that member banks should no longer sit on the board of directors of member banks of the Federal Reserve System. Thank you, sir.
Thank you for your testimony. And we'll now turn to member questions. The chair now recognizes himself for 5 minutes for questioning. Professor Scott, I'll start with you. Are we relying too much on the Federal Reserve to intervene in financial markets and the economy, and sometimes expecting the Fed to engage in emergency lending that could be done as a fiscal policy operation using a program housed at the Treasury instead?
As one of my points that I mentioned in my oral testimony is I don't think that the Fed should be taking substantial credit risk when it makes loans, okay? And that occurs when there's not sufficient collateral. Under 13.3 during COVID, that gap was made up by Treasury's backing of the Fed's loans. But, was this backing sufficient? The Fed was still taking risk, substantial credit risk. In my view, that's fiscal policy. That should be done by the federal government, not the Fed. So Main Street should be PPP, not Main Street, okay? And second, when you loan under 13.3, there's kind of a dual sign-off. The Fed has to sign off and the Treasury has to sign off. And I can tell you, during COVID, in the operation of Main Street, and I wrote op-eds on this subject, it was very hard to say who was responsible for the design of Main Street. Was it the Treasury or was it the Fed? So when you have two sign-offs, as we have on 13.3, it's very hard to pin responsibility. So for those two reasons, I would say if the Fed's taking substantial credit risk, it should not be Fed lending, it should be the government.
Thank you. Mr. Nelson, what, if anything, would you recommend that the Fed do to reform its discount window or 13.3 policies, procedures, and operations?
So as part of a preparation of requiring banks to pledge more collateral to the discount window, I think the Fed should certainly review its discount window policy, collateral operations and procedures to make sure that they're as efficient as possible. I say that, but I also recognize that the Fed has always sought to make the collateral pledging process as efficient as possible, and almost all collateral is already pre-positioned at the Fed, subject to keeping the Federal Reserve and taxpayers safe. So I'm not really certain that there's a lot of low-hanging fruit available there. In fact, my guess would be that there isn't, first of all, because Fed staff would have already plucked it, but also because I've talked to many of my member banks of BPI about this issue, and many of them they haven't generally indicated dissatisfaction with the collateral pledging process from the Federal Reserve Bank. But in addition, I think that the Fed needs to go back to review how it's doing things, to go back to its 2003 revision, the last time it revised Regulation A. It moved the discount window to an above-market rate so that it could let the rate itself govern a bank's decision to borrow and remove any questioning. I would go around and talk to the reserve banks, make sure that the borrowing was kept secret. We had a joint SR letter written by the supervisory agencies recognizing that the discount window is an important tool for liquidity risk management. So I think that the Fed needs to redouble it, and that was working. Over time, that was gradually reducing the amount of stigma that was available. So I think going back to that, no questions asked, it's a bank's decision to borrow, educating the public, educating Congress about the importance of the discount window would be a critical change.
Yeah, and I'm very intrigued by your recommendation that banks are not, when you say banks are not allowed to assume that they borrow from the discount window in either the liquidity coverage ratio or their internal liquidity stress tests. What does the Basel III Endgame proposal do about this in exacerbating that problem? And do you believe that Congress needs to legislate in that area to remove the stigma?
Basel III doesn't mention the discount window. It doesn't come up. And I don't.
Would it exacerbate the stigma?
It shouldn't really have an effect.
In effect.
Either way.
So, but would you recommend that Congress take action or just the Fed in the application of stress tests and the LCR?
One action that Congress could take that would help with stigma is to go back to keeping borrowing secret. It's true that when you borrow from the discount window, the names and the identities of the borrowers are released after a 2-year lag. And that may seem not to matter much, but I've been assured by bankers that actually really does matter. And moreover, when I used to go around to banks and try to convince them to use the window, it mattered a lot that I was able to say, this is kept secret. It's less compelling to say, this is kept secret for 2 years and then it's revealed.
My time has expired, but Professor Scott, if you could, in answers to other questions, throw in the lessons that you think we should take from the experiences of last March in ways to improve the Fed discount window lending and the role of the Federal Home Loan Bank lending to financial institutions. With that, the gentleman from Illinois, Dr. Foster, is now recognized.
Well, thank you, Mr. Chair, and our witnesses. I'd just like to start out by saying that I agree with Professor Scott about the desirability of separating the Fed's role as a lender of last resort with, basically bailing out businesses that were in trouble that we think that deserve bailing out. And so those are, I think if we can find a way to do that. The issue that I saw at the time was just the capacity of the Fed was when we had to get a lot of money to a lot of different businesses really fast. The Fed was the only, and so we have to pre-position, the pipelines to make, if we have to do a broad-based business bailout, that we have to find a mechanism that's well-defined ahead of time to make that work. Professor Scott, are there any specific proposals that you're aware of for separating those two functions explicitly?
I think the Fed could remain the distributor of funds without being the lender of those funds, okay? So the critical thing to me is when we're dealing with fiscal policy, it should be the government. The government can use the Fed, okay, to distribute those funds. The Fed can play an operational role, okay, in getting those funds to small business if the Congress and the government so order that. So what I would like to see is the Fed not be the lender under those circumstances.
Okay, and I agree with everyone's comment about the stigma. Just some elementary questions. Do the large banks at least exercise the ability to do transfers out of the window? Is that, are the pipelines in place and are they tested with some trivial amount of money regularly? I know of at least one bank where I've asked that question and they said, yeah, of course. It's some microscopic amount of money so that, so that they don't feel the stigma. But is that a universal practice or should it be made a universal practice to at least exercise the window?
Yes, actually, I'm sorry.
Yeah, go ahead, sure, yeah.
Okay. So during March 9th, when SVB was trying to transfer its collateral to the Fed through the Bank of New York Mellon, it couldn't be done because we had to have a test procedure to determine whether such transfer could be made, okay? That should be like automatic at this point. Shouldn't be running test procedures when you have a bank, in distress. Just one further comment on stigma, because it's come up here. Part of the reason the BTFP was created, or one of the aspects of it, was the rate at which people could borrow from that facility compared to the rate that they could borrow from the window, and it was lower, okay? And so as a result, it was so low that they could borrow from BTFP and did, and, make an arbitrage by putting their money at reserves and getting a higher rate from the reserve account. And the Fed put an end to that in January. But what it underlies is the response to stigma was to lower the borrowing rate so people could say, hey, I'm not borrowing because I'm in trouble, I'm borrowing because it's a great rate, okay? In the
I
financial
agree,
crisis.
that was not optimal, and,
I'm sorry.
you know, there were letters in the Fed to, in preparation when the Fed made that move, because it, could you say a little bit, because any of our witnesses, about the sort of the nuts and bolts of pre-positioning capital at the window? What exactly, what does that mean? What are the downsides? What are the costs of doing that? Why isn't a uniform practice already to pre-position our, you know, an amount of capital? And you also, to do that, you have to understand what fraction of your deposits and so on are actually flighty. If you're going to say you should pre-position adequate for quote-unquote flighty capital, are there clean definitions of what's required there? Mr. Nelson, do you want to have a swing?
So the Fed has always accepted collateral, at least for decades, accepted collateral and maintained pools of collateral from banks pre-positioned at the window. That's how it's done. 80% of the lendable value of bank collateral are loans to businesses and households, and those all have to be pre-positioned.
So when people refer to the costs of doing that, are the costs significant? Since nothing's actually happened, if it's sort of pre-positioned, it's my understanding they're not.
There's costs. There's a few costs to consider. One is that it does take time and work to set up the arrangement, and banks do need to provide the Fed with information on the loans that are pledged. The bank maintains possession of the loan collateral, but then provides the information that's necessary in order to value the collateral and apply a haircut to come up with the lendable value. It's also true that banks use collateral for lots of things. They collateralize municipal deposits, they collateralize their federal home loan banks, and those things, so there is a cost to keeping that collateral.
So if actually any of you want to respond to the record of what that could, a stronger version of pre-position collateral and the standards for how much you'd have to pre-position, you know, what that could actually look like at a sort of operational level.
And the witnesses can submit that for the record, and the gentleman's time has expired. The gentleman from Missouri, Mr. Luchtenmeyer, is recognized.
Thank you, Mr. Chairman, and thank the panel for being here this morning. Great thought leaders here. Mr. Johnson, you brought up a subject that's kind of near and dear to my heart, that after the debacle of last spring with our banks, I came up with, and after, as looking at this from outside the box here and coming up with some ideas of how the kind of risks that we're taking there, from the standpoint that, you know, a gentleman was sitting actually in Mr. Scott's seat, who was the chairman or the president of the board of CBB, and said he had $42 billion run out in 10 hours. And to me, this is as a result of a tweet. We're living in a different world than we did 2 years ago, 5 years ago, 2 months ago. And now you brought up something in your comments with regards to artificial intelligence. You know, I sit on the China Select Committee. It scares the heck out of me because we've just handed the Chinese the way to mess with our banking system and our economy. All you do is short sell tonight, go up tomorrow morning with a tweet, or had an artificial intelligence Facebook post of Larry Kudlow, Bloomberg, Dave Ramsey, somebody who is respected in the investment field. It could be an artificial individual on there, and nobody could tell the difference. I've seen these commercials myself. You can't tell the difference between. And you have somebody of that reputation go up there and say, I've got 100 banks that are in trouble. And suddenly it's like, wow. And you have real-time payments. You have instantaneous ability to make these transfers, and all of a sudden now you do have a run. People kind of laugh at me when we talk about runs. I say, you know, we had a run on toilet paper 3 years ago. Don't tell me you can't have runs. I think people value their money more than they do toilet paper. But so, you know, one of the things I think that we need to do is have the ability of the regulators, FDIC in this situation, to have, and you made this comment with regards to transaction guarantee of accounts for a short period of time, to be able to stymie this sort of run, nip it in the bud before there's a contagion here that goes through the entire system. I appreciate your comments on that.
Congressman, I think you're exactly right on all the dimensions there, including the fact that the AIs can already fake images and messages very credibly. And then the point made by Gary Gensler, actually, when he was still on the faculty at MIT before he joined the SEC, was we should think about a future in which financial institutions tend to use similar AI engines themselves internally, which will be reacting to the messages from the outside, which will just exacerbate the speed of runs. So that's exactly why having the FDIC with the Treasury and arguably with the Fed, because they can all move fast, giving them the ability to put a temporary transaction account guarantee program in place very quickly, I think is exactly the right direction to go. This would not be a substitute for the other things we're talking about today with discount window, but it would be a complement, and I think it would be very consistent with the objectives of this committee.
I think it's a tool. The regulators need to have a toolbox. I'm not trying to protect a single bank here. I'm trying to protect the system from going down when you have a run that can be a contagion that could spread to everything. Mr. Scott, I know your comments in your written testimony was similar along that line. Would you like to comment at all?
On this point?
Yes.
Yep. Well, I agree with Professor Johnson that I think this power needs to be restored. I think a key idea of the Congress at the time was it could restore it, okay, by a joint resolution. I think given the speed by which these runs occur, that's impractical, okay, to get a joint resolution in time to actually get the authority to extend.
That's the point of my bill, is the fact that we can't sit here and wait for Congress to act. The regulator has to have this tool in the toolbox that they can instantly make this situation resolved and not have to wait on Congress. And so
Yes.
For a short period of time, they have the authority to do this. At the end of 30, 60 days, we pick a time frame, then Congress can act and extend it or not extend it, and then you're off and running. But we live in a different world where this instantaneous ability to do things today is such that we've got to be able to instantaneously react. And if we don't, I'm fearful. So I have a bill to do that. I appreciate your comments on that. Mr. Scott, with regards to the term funding, the short-term funding programs that the Fed's put together here, I kind of like them to keep this program up and running. I know you're not a big fan of that, but so the question, it begs the question that, we have, the problem that happened last spring was we had some interest rate problems. Some banks were upside down on interest rates on long-term, short-term. Has those rate problems dissipated yet? Or do we have some banks? I guess, do we have some banks still with liquidity problems as a result of long-term assets being for lower rates?
I'm sorry, I'm a little hard of hearing sometimes.
Okay.
I don't get you. I don't think they need to keep it in place because my basic point is it's not necessary at all. If they're going to do this kind of thing, it should be through the window, okay? Through the
Isn't the window for short-term? Is
authority.
the window for short-term lending versus the need to have some long-term liquidity here?
No, but in terms of having this liquidity,
Yeah.
I think the policies under,
The gentleman's time has expired.
I don't think we need to extend this facility.
All right. Thank you. Yield back.
The gentleman from the gentlewoman from California, Ms. Waters, is now recognized.
Thank you very much, Professor Johnson. We will soon be marking the one-year anniversary when we witnessed the sudden collapse of Silicon Valley Bank and Signature Bank last March, and then shortly after, First Republic Bank. Those were three of the four largest bank failures in United history. On the weekend that SVB and Signature Bank failed, I convened a number of member calls with the regulators, and I was pleased to see how the Biden administration, led by Secretary Yellen, worked closely with the Federal Reserve and the FDIC and used their emergency tools to quickly stabilize the situation. As part of their actions, the agencies invoked a systemic risk exception to protect uninsured depositors, and the Fed used this emergency lending authority to set up the Bank Term Funding Program to help other banks that had securities portfolios with large amounts of unrealized losses to be able to have access to liquidity. Professor Johnson, do you think that these quick actions of Secretary Yellen, Chair Powell, and others were appropriate and helped prevent a broader financial crisis?
Yes, Congresswoman, I think those actions, under the circumstances and given the constraints which we were just discussing in terms of the fact that the Transaction Account Guarantee Program was not available short notice because of the terms of Dodd-Frank, I think the measures that they took, both individual measures and the package in which they put them together were entirely responsible and saved us from a much more severe financial crisis.
Thank you. Professor Johnson, you also raised how important it is for banking regulators to finalize the Basel III endgame proposal to strengthen bank capital requirements. I agree with you, but we received all sorts of statements from the banking industry claiming the sky will fall and banks will stop offering loans to underserved communities if the rule is finalized. Should we believe their statements? Like some believed SVB's CEO back in 2015 that it was okay to deregulate regional banks since they never pose a systemic risk. Would you discuss why this rule is so important?
Ms. Congresswoman, so as I referenced in my written testimony, I am the co-chair of the CFA Institute's Systemic Risk Council, a body that was founded by Sheila Bair, the former chair of the FDIC. And we sent a letter quite recently to the regulators with regard to Basel III. And our position, the Systemic Risk Council is comprised of various Republican, Democratic, and international European former officials. Our view is that completing Basel III at this stage and at this moment for the United States is important. We are not convinced by the arguments that it will cause economic disruption or difficulty. In fact, our view is that well-capitalized banks are more likely to be robust lenders throughout the business credit cycle, therefore strengthens economic growth prospects for everyone in the United States.
Well, I heard someone say, oh no, it had nothing to do with capital that caused those banks to fail. It was all about mismanagement. Isn't a lack of enough capital mismanagement? How could you separate the two?
The lack of capital or potential insolvency is absolutely intertwined with issues of liquidity pressure in many financial crises, and it was absolutely in the case of Silicon Valley Bank, where investors came to believe, and in part through the rumor mill, but there was definitely some foundation for this, that Silicon Valley Bank had a potential solvency problem, and therefore might be a good idea to move their deposits, their uninsured deposits, elsewhere. So that's a liquidity problem, or the run on the bank, as people were trying to not go to cash, but go to other safer banks. That was absolutely intertwined and really tightly connected, Congresswoman, as you're saying, with the capital deficiency, the lack of capital, and the potential insolvency.
Some believed SVB's CEO back in 2015 that it was okay to deregulate regional banks since they never pose a systemic risk. Would you take a minute and discuss why this rule is so important?
Well, as I mentioned, Mr. Becker, the CEO of Silicon Valley Bank, did send a letter with saying exactly this Senate Banking Committee in 2015. I testified to that committee on the other side of that argument, and I have to say I think Mr. Becker's letter is entirely wrong. I think that Silicon Valley Bank absolutely and manifestly did end up posing systemic risks.
Thank you very much. I yield back.
Gentlelady yields. The gentleman from Georgia, Mr. Loudermilk, the vice chair of the subcommittee, is now recognized.
Thank you, Mr. Chairman. Thank you all for being here. Mr. Nelson, earlier, chairman of the committee here, subcommittee, outlined the number of times 13.3 has been used since 2008, and especially the increased frequency that has been used in the last few years. Do you see this increasing use of 13.3 facilities as a general trend toward reliance, or is it still as a response to specific conditions?
I think that there's inevitability that once you start using it, you start to use it more. So I think that there is a sense of general trend. You know, when I used to go out and talk to people about using the discount window back before the global financial crisis, at times I'd be asked, well, would the Fed ever use 13.3? And my answer was always, no, absolutely not. They haven't used it since the 1930s. But of course, you know, the global financial crisis hit and they used it, and I was very involved in that. It was appropriate. But then COVID came around. They immediately rolled out all the same facilities again. So it's clear now that, that in response to troubles, opening a broad-based facility for non-banks under 13.3 is on the table. And that has moral hazard consequences. I remember talking to money market mutual funds about the effort to reform them after the global financial crisis, and the answer was, in some cases, well, why is that necessary? If there's trouble again, the Fed will just open up a new lending facility for us again. And as COVID hit, that's exactly what happened. So, and the risk is that the institutions that receive 13.3 loans generally tend to be ones that are not as stringently regulated as commercial banks, so they don't have the same controls to control the moral hazard.
So instead of a option of last resort, per se, as maybe it was intended, this has become the default go-to?
I think that's probably going too far. I don't think it's become a default, but nevertheless, I'm sure on everyone's mind is now that if sufficient trouble happens, the Fed will be able to open a 13.3 facility to
The
address it.
safety net is always there.
The safety net is expanded.
All right. With the Fed's progress toward real-time 24/7 services in other areas, do you believe it would be beneficial to extend the operating hours of the discount window?
I do. The critical question is actually the operating hours of Fedwire and the National Book Entry System for securities. You could make a discount window loan in the middle of the night, but you couldn't book it to the institution's account because Fedwire is closed. So the Fed is studying and has expressed a desire to extend Fedwire to 24/7, and that would make a lot of things a lot simpler, but I don't know how difficult it is.
Do you think if they did do this, would it reduce the reliance on special credit facilities during periods of instability?
I think it would not necessarily, because the institutions that would have access to those 24/7 facilities would all be commercial banks, ones with accounts at the Fed. So
Are there any technical or logistical obstacles that might prevent the Fed from doing this?
I don't know. I'm sorry.
Can you explain how services like Fedwire might have played a role in preventing Silicon Valley or Signature Bank from accessing liquidity through the Fed's discount window?
So as Professor Scott mentioned, it was, as was reported in the press, during the efforts to keep Silicon Valley open, they had trouble getting securities from their correspondent bank in New York into their accounts so that they could lend against them. The facilities close at 7 p.m., which is a normal time for things like that to close, but that's Eastern time, and so 4 o'clock Western time, and extending the hours would have helped.
Okay, thank you. One of the requirements to use 13.3 authorities is to affirm that the participants cannot secure credit accommodations from any other institution. In theory, this is an important safeguard to prevent the misuse of 13.3 facilities. How is this safeguard applied in practice under truly exigent circumstances?
So each time the facility is used or created, the Fed looks at and determines that that similar credit is not available elsewhere.
Okay. Last March, the Fed set up the Bank Term Funding Program facility, a 13.3 facility. The BTFP lets borrowers pledge securities and get a loan at par value, not market value. Since then, the program's credit extensions have reached around $165 billion and is slated to expire in March of this year. Do you believe that the program achieved its intended purpose?
I do. I mean, viewed from the outside, it appeared that what happened was the Fed, that SVB weekend, looked around and looked at the uninsured deposits that were out there that could run and the amount of collateral that was pledged by the institutions subject to those runs, and they've judged that to be a necessary response. And it was one that allowed them to move collateral very quickly because book entry securities can be moved immediately and in large amounts. I think that it entailed a lot of risk, though.
All right. Thank you. I yield back.
Gentleman yields. The gentleman from Georgia, Mr. Scott, is now recognized.
Thank you, Chairman. Mr. Johnson, welcome. Now, I truly believe that the Fed's discount window can be very helpful, but we got a problem. And our banks are scared to use it because they fear it's going to hurt them with their investors and depositors. And that is, even if we're waiting 2 years before we even tell anybody that they're using it. So what can we do? What else can we do to really deal with this problem?
Well, Dr. Nelson has proposed to remove the requirement to disclose who borrows from the discount window. I think the problem with that is, Congressman, that there's already a great deal of concern that the deal that banks have with regard to the Federal Reserve is actually a pretty good deal and not available to other parts of the economy. So I think actually making that secret again would be problematic, including, given, as I mentioned, the governance structure of the regional feds, where banks sit on the boards of these feds, which would then be giving them advantageous loans in secret. It's very difficult, I think, to make that work politically. and with the country. I think, Congressman, that the transaction account guarantee program that we previously discussed would be very helpful to achieving your goals and the goals of this committee, because the point is that if that program is available, there can be losses for one entity. Let's say Silicon Valley uninsured depositors might have lost 5 cents in the dollar. That's one reasonable estimate. And they would have got a lot of their cash back, by the way, within a couple of days. That's the way the FDIC operates. But the tag would have been applied to all other banks throughout the system, small, medium, and large, on a temporary basis. And that would have prevented the panic and the fear that was going to drive other depositors, other insured depositors, to the mega banks in the following days. So I think as a belt and suspenders approach, as a backdrop to the discount window, for which I really don't think we're going to get past the stigma completely, ever, I think you need the tag program.
So if we're not going to be able to get rid of it ever, in your estimation, do you think that we'll have more Silicon Valleys, more bank disruption, more hurt to our economy? Are you saying that this is something we're going to have to live with, or can we solve it?
I think we live in a very unpredictable world. As Dr. Nelson said, we've had three major disruptions, three needs to use the 13.3 powers over the past 15 years. I don't think the world is going to become more stable, Congressman. I think 13.3 is available. I understand Professor Scott's reservations about it, but it is available precisely when non-banks are in trouble, so not member banks, or when you need to provide some support to banks and break through that stigma barrier. But the 13.3 powers, as we saw in the case of Silicon Valley Bank and Signature Bank, are not sufficient. That's why they did the systemic exception.
Yeah, and you mentioned, Dr. Nelson, let me ask you, the Federal Home Loan Bank System is a source of collateralized borrowing that some banks tend to turn to when they need liquidity. How do you feel about that? Is that a way out of this?
So the Federal Home Loan Bank System is an important means by which smaller and regional-sized banks conduct regular asset liability management when they need funding, and that's an important role. But at the same time, there's a significant moral hazard and problem with the Federal Home Loan Bank System in that the securities that it issues to fund itself are viewed as guaranteed by the government, but they're not guaranteed by the government, and that's a recipe for systemic risk. Addressing that problem would require a lot of careful consideration because of their role in the banking system. That said, one role that they are not suited for is to be lender of last resort, and that's for three reasons. The first is that, as I mentioned, the Federal Reserve, as we've discussed, the discount window is open till the end of the day. It's the last mover. The second reason is that at times being lender of last resort requires lending vast amounts of money, and that money is not, the Federal Home Loan Bank System doesn't have that. They have to borrow it. That takes time, and it can add to the stress in the financial system. And the third reason is that when the Federal Reserve, sometimes being a lender of last resort requires adding reserves to the banking system. And when the Federal Reserve makes a loan, that expands their balance sheet and it creates reserves, but not for Federal Home Loan Bank loans.
Well, thank you, and I think we can find a way out of this. I really do.
Thank you. The gentleman's time has expired. The gentleman from Tennessee, Mr. Rose, is now recognized.
Thank you, Chairman Barr and Ranking Member Foster, for holding the hearing, and thank you to our witnesses for being here with us today and sharing your time and expertise. Dr. Scott, in your testimony, you discuss how the development of transfer speeds has resulted in bank runs that have gone from taking 10 days down to effectively 1 day, maybe hours. What impact do instant transfers have on the ability of the Federal Reserve to respond to bank runs?
Well, for one thing, I think SVB teaches us that they have to be responding quickly because the runs are happening quickly. So their operations need to be set up to permit that. And as I think we discussed with FedWire, they were not. They have to be improved. I would like to see more operational improvements so people could transfer collateral to the Fed and receive funds instantaneously. Technically, this should be possible in the modern world. So I think those are clear operational improvements that the Federal Reserve should make.
And so as we think about technology, Dr. Scott, obviously it will continue to advance, and we'll see the quickness, the rapidity of these things probably increase, not decrease, as we go forward. Certainly the ability to communicate concern in the marketplace is almost instantaneous at this point, and the ability to move funds is very quickly becoming instantaneous. What does the Federal Reserve, besides the things that you've said, what changes in technology do they need to implement to respond to these runs quicker and quicker?
Well, I'm not a techie, so I can't give you the details. But I think if we have a world with AI, we can sort of figure out how to move funds fast and get collateral to the Fed. So I'm sure that technical people can figure that out pretty quickly and set up a system to do it.
Is the Fed and the other regulatory establishment, are they equipped from a policy perspective to make such quick decisions?
Well, I think they learned a lesson here. By the way, the next day, when they were dealing on Friday with Signature, they left FedWire open till the end of the day. Okay, so in terms of the operating hours issue, they learned a lesson. But I would like a lot of improvement here just from the movement of the collateral to the Fed instantaneously. So again, I can't give you the technical way to do it, but I'm sure that others can.
Thank you. Dr. Nelson, in March last year, the Fed set up its bank term lending program to let eligible borrowers pledge eligible securities and get a loan to value equal to the par value of those securities as opposed to the current market value. Currently, credit extensions in the bank term funding program are about $165 billion, and the program is scheduled to expire in March of this year. Do you believe that the program was successful, and was it useful?
I believe it was successful. I think it's too bad that it was necessary, but I do think that it was successful in that it allowed the Fed to quickly gather a lot of collateral from institutions that depositors were worried about and enable them to potentially meet runs. But it was, but the fact that the Fed was lending in a partially uncollateralized way at a low rate for long terms are largely inconsistent with standard lender of last resort practice. So, a better approach, and one, so it's great that we're having this hearing today, is that banks be prepared to borrow from the discount window, pre-position large amounts of collateral in advance.
Should the facility be maintained in its current form?
No, Congressman, it should be ended.
And so thinking about that, the risks of this program, such as moral hazard that may be associated with it, comment on those.
So I would say that, in general, the Federal Reserve should not be, I don't think it's ever happened before, to my knowledge, that the Federal Reserve has lent in a partially uncollateralized way. And so, that's, and it's particularly at a rate that is a below market rate. Once markets shifted to expecting a decline in rates, the way the rate was calculated, as Professor Scott mentioned, it became an arbitrage to borrow from the program and simply deposit the money at the Fed. Both of those are unattractive features of a central bank lending program.
Are there any market implications from the program being terminated?
I don't think so.
All right. And Dr. Scott, you are aware during the 2023 Silicon Valley Bank crisis, the Federal Reserve stepped in and backstopped the deposits of investors that were uninsured. You have advised that Congress should restore the ability to increase deposit insurance in a crisis. What would be benefits and harms of doing so, Dr. Scott? And I see my time has expired, so if you could answer that for the record, I'd appreciate it. And Mr. Chairman, I yield back.
Gentleman yields. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman, the ranking member. I appreciate the opportunity to speak here. And I especially appreciate the witnesses today. I think you've been tremendous in what you've said so far, and I also appreciate your service. Appreciate it very, very much. I will have 3 areas I want to cover: climate change, insurance companies and the industry, and AI. First of all, do you believe in climate change? All 3 of you? That's refreshing. Sometimes we hear that we don't. So I do think that the world is changing, and I think it is dramatic. We saw in San Diego recently a 1,000-year flood that's happening all the time now. And I say this because now insurance companies are starting to leave areas of the country or not renewing policies because of climate change and now the risk that they see. We've been talking mostly about banking, the last resort of banks to loan from the Fed, but also AIG was brought up earlier. And I do want you to comment a little bit about that, about the potential for insurance companies here, because I do think that we're going to run into some problems that some insurance companies are going to become insolvent because they're not appropriately reserving. Could you comment on that? Because it's a very different type of collateral, it's a very different issue when you have an insurance company versus a bank.
So perhaps I'll go first
Yes.
on that, Congressman. So first of all, let's remember that AIG failed because AIG Financial Products, which was an offshore, London-based quasi-hedge fund,
Sure.
took on massive exposures. And that was an absolutely crazy idea. And that's one reason that Basel III, for example, emphasizes the need to have is part of a package of consistent approach to regulation in the EU, the UK, and the US. That's tremendously important for insurance and other parts of the financial sector. And that's something that the Systemic Risk Council has written about, thinks a lot about, that consistency. With regard to the climate change impact, I'm sure you're absolutely right that particularly extreme weather events in some parts of the United States pose major risks to everyone, including homeowners, including insurance companies. I think the bigger risk you're going to see there, Congressman, is exactly what the reports from Florida, for example, where insurance companies pull out because they can't raise rates or not allowed to raise rates or don't want to raise rates to match the risks. So then who is left holding those risks? Is it the homeowners? Is it the state? Who else is it? I don't think we've seen that come through into banks. I think banks have other issues right now, including commercial real estate, that are absolutely worthy of discussion. But I'm not sure we've seen exactly that impact yet on the banks. But, to the previous discussion, I think future financial crises may come to us from many directions. And having come to us through climate change and extreme weather events is entirely possible.
Would anybody else like to comment? Yes, Professor. Oh, yeah, I see that you're...
So, climate change is a serious problem, and it's appropriate that the regulatory agencies that are responsible for regulating carbon risks do so. I think we can also agree, though, that bank supervisors should be focused on safety and soundness and financial stability risk. Study after study after study, including 2 by the New York Fed and 1 by the FDIC, have failed to find any relationship, any negative impacts, material negative impacts on the banking system by climate events. Moreover, if banks are required to devote resources to climate risk, that means those resources are coming from somewhere else. So I do think that, I'm just remain concerned that the reasons why the banking agencies are focusing on climate risk is, a well-intentioned desire to do something about it, as opposed to a carefully considered assessment that it imposes a financial stability or safety and soundness risk.
Well, I don't know that I would agree with you fully on that, because you do see that banks loan, obviously we're talking about the collateral and the business loans that they have in homeowner loans, and a lot of these loans, of course, are to very expensive homes along the coasts. And so when you do have issues of climate change, obviously that could affect those loans that are used for collateral. So I'm not sure that I fully agree with you, but if you'd like to comment on that. Oh, okay. Well, I do want to go on to for the last few seconds that I have here, AI. So a scenario was given to you by Mr. Lukemeyer about AI fraud, but what about AI that's not fraud? I mean, it seems that now we have a real issue here with AI that's not fraud that could cause some real problems for the banks. Could you comment on that very quickly? Yes.
So I commend everyone to read Gary Gensler's paper that was written before he joined the SEC, which actually modeled and hypothesized exactly that completely legitimate AI adopted by banks and other financial institutions for entirely legitimate business purposes and making sense on an individual basis, the way those AIs can interact, particularly if they're very similar to each other, could exacerbate run risk and create systemic risk. And that would not be because any individual firm was doing something stupid or irresponsible. It's the way that those risks would aggregate up through legitimate AI. That's a very serious possibility.
Gentleman's
very
time
much.
has
Thank you.
expired. The gentleman from Wisconsin, Mr. Fitzgerald, is now recognized for 5 minutes.
Thank you, Mr. Chair. Mr. Nelson, you note in your testimony that before a Federal Reserve Bank can lend to a commercial bank, it must work out the subordination agreement with any Federal Home Loan Bank that has collateral pledged to them by that commercial bank. And obviously, this is because both Federal Reserve banks and the Federal Home Loan banks are required to perfect their security interests in any collateral that they attempt. My understanding is the Home Loan Bank usually will take mortgage-related collateral, while the Federal Reserve Bank will take consumer, commercial, credit card, and other non-real estate loans as collateral. And I know that the FHLB in Chicago provides regular quarterly reports to prudential regulators of its bank members about their borrowing. So to Mr. Nelson, I'll ask you first. What has your experience been with the communication and coordination between home loan banks and the reserve banks in times of crisis? And are there ways that you can think of that we could improve the coordination between the two entities?
So as you note, Congressman, for every Federal Home Loan Bank member, commercial bank, the corresponding Reserve Bank and Federal Home Loan Bank work out an agreement between them about what collateral would be pledged to the window. Because as you know, the Federal Home Loan Banks are secured not just by individual assets, but by a blanket lien on all of the assets of the institution. Consequently, the Fed can't get a perfected interest in the assets of that institution. So what happens is the two get together and they identify categories of loans that can be pledged to the Federal Reserve, and the Federal Home Loan Bank subrogates its interest to the Federal Reserve for those categories. And those tend to be ones that the Federal Home Loan Banks don't give lending value to, so non-real estate assets, consumer loans, and business loans. Now, obviously, that takes time and effort, and so it can't be done in a crisis. One change that could be considered would be to, it seems to me that a better arrangement, more appropriate to the role of the Federal Reserve as lender of last resort and the Federal Home Loan Banks as providing regular asset liability management lending, would be to flip the situation and provide the blanket lien to the Fed and take it away from the Federal Home Loan Banks.
Very good. As we take a comprehensive look at contingent liquidity and federal emergency lending issues, I would ask that we also consider the credit unions and their importance of having strong backstops in place for those institutions. In addition to FHLB advances and access to various Fed programs, credit unions have access to a central liquidity facility, a federal function maintained by the National Credit Union Administration. It's essential that Congress ensures that the central liquidity facility is up to date and ready to provide efficient and adequate contingency liquidity to the credit union system in the event of liquidity stress or some type of distress. So, Professor Scott, what's the most important reform that we could make to the lender of last resort function?
Could gentlemen turn your microphone on?
If I had to pick one, I would go back to my point on COVID. The Fed should not be getting into situations where it's doing fiscal policy, okay, as it did with the Main Street lending facility during COVID. There should be a government role. It should be Treasury implementing that policy with appropriated money or appropriated guarantees. So I think we need to get the Fed out of fiscal policy. That was the COVID lesson. It wasn't SVB. But let's remember, the Fed played a huge role, okay, in lending to Main Street, lending to corporations generally, providing credit. I don't think that's the role of the Fed.
Very good, interesting. A recent report on 2023 banking crisis by a group of 30, the group of 30, proposed a requirement that banks pre-position enough collateral with the Fed to support loan loss revenue loans sufficient to cover all banks' runnable liabilities. In recent remarks, acting comptroller of the currency, Sue called serious consideration of a new liquidity requirement that would involve the pre-positioning of collateral at the Fed. Professor Scott, can I ask you, do you think such a pre-positioning requirement is a necessary reform?
I don't object to pre-positioning. If the banks want to use it, they should be able to pre-position collateral.
Thank you.
Where I would draw a line is a requirement that they.
Gentleman's time has
Thank you, Mr.
expired.
Yield back.
The gentleman from California, Mr. Sherman, is recognized for 5 minutes.
Earlier, we discussed AIG. I would point out that you had a management capable of bankrupting the whole institution by its crazy bets in the one entity that they had that wasn't regulated by state insurance commissioners. And in spite of that management wasn't able to bankrupt any of the regulated insurance companies. I think this was the most impressive show of effective state regulation of insurance companies, and also shows that credit default swaps are basically insurance. We could structure my fire insurance policy that if my house burns down, they don't write me a check. I just trade my deed for a short-term treasury bill. I guess you'd say, well, then it's not an insurance policy. It's just no, this is, we need to realize that many things we call derivatives are actually insurance. At least we're regulating them better as derivatives. The other thing I'd point out is that there seems to be a tendency among bank regulators to undercount the importance of interest rate risk. $1 million treasury bond issued 25, 30 years ago is worth $600,000 today. Let me just ask Mr. Scott, would the Fed discount window lend more than $600,000 on a $1 million treasury note that had a fair market value of $600,000? Will they lend more than current fair market value?
Well, not only would they did. From the bank term facility program, once they put this program in place, they valued securities not at their market value, but at their par value. They were.
Wow.
Yep.
And this is kind of an unauthorized, uncongressionally authorized bailout when a bank can go to the government and say, I have an asset that everybody in economics understands is worth $600,000, and you're going to loan me $1 million against it. I remember TARP, we had to authorize that here in Congress. So the Fed does lend money on assets based on the myth that it's worth more than you could sell it for.
Not
have that
only
right?
do they do that,
What?
Congressman, but under the discount window, which was not the BTFP facility, that was 13.3, the Fed is not required to have collateral, okay? It's not required. They only need to have collateral to their satisfaction.
Gotcha. Let me,
I think
I need to spend the rest of my time focusing on the Federal Home Loan Bank. There's this attitude that somehow it's a red flag, although in our area we've seen J.P. Morgan, Wells Fargo, Bank of America be be major borrowers. Is it a red flag for an institution? Does it symbolize that they're not solvent to borrow from the Federal Home Loan Banks? Yeah, Mr. Scott.
I think they're borrowing from the home loan banks as Bill Nelson said, to manage their assets and liabilities on an ongoing basis. So I don't think, they're borrowing from the Federal Home Loan Banks is actually as much seen as a stigma as they would be borrowing from the discount window.
Okay.
Bill may want to comment on that.
It's clear from the statute, the Competitive Equity Banking Act of '87, that the Federal Home Loan Banks are a lender, not the lender, a lender of last resort, and I ask unanimous consent to put in the record the conference report from that act. I ask unanimous consent to.
Without objection.
The Federal Home Loan Banks continue to serve an important source of liquidity for small community banks. In the aftermath of the Silicon Valley, it took the Federal Reserve 3 weeks to establish a bank term funding program. Dr. Nelson, Had it not been for the Federal Home Loan Banks Act asking as a lender of last resort during those weeks, would we have had some bad consequences in the Main Street economy?
The gentleman's time has expired if the gentleman answer for the record. The gentlewoman from California, Ms. Kim, is now recognized for 5 minutes.
Thank you, Chairman. I want to thank the witnesses for joining us today. My home state of California saw firsthand some of the biggest bank failures in history with SVB, the First Republic Bank. And in the case of SVB, we know that its failure was due to the perfect storm of the bank mismanagement, financial regulatory failures, liquidity, and social media panic. Mr. Scott, in your written testimony, you mentioned that the Fed, in quote, was operationally unprepared for the unprecedented speed of the run, end quote, of SVB. So can you elaborate on why the Fed was so unprepared? And can you point to any changes that the Fed has implemented since the bank failures to be better prepared?
I can't say why they were unprepared. I don't know. But I think I've said a few times today that, they weren't prepared to extend the operating hours of FedWire. They weren't prepared to facilitate the transfer of collateral from the Bank of New York Mellon, which was holding collateral for SVB, to the Fed. They were not prepared for that. Why they were unprepared, I do not know.
Well, in your testimony, you also indicated that SVB possessed hold-to-maturity government securities that could have been pledged as collateral to cover the run on deposits. So can you elaborate on that? Why SVB did not pledge this collateral to borrow from the Fed's discount window?
Well, they couldn't get it there. The next day, when the Fed created this other facility, they agreed to value the hold-to-maturity assets at par. But they had a lot of value anyway, even at market value, and they couldn't transfer those assets over to the Fed. My calculations, actually, even if you looked at the hold-to-maturity assets at market value, we're talking $70 billion, something like that. So they had tremendous borrowing capacity from just those assets at market value, which they could not get to the Fed to borrow.
Okay, Mr. Scott, let me move on. There is a stigma associated with borrowing from the Fed's discount window. Furthermore, current law also disincentivizes banks from utilizing the Fed's discount window when there is a liquidity crisis. Mr. Nelson, Chairman Barr touched on this earlier, and I would like to follow up on that. How could allowing banks to assume that they borrow from the discount window in the liquidity coverage ratio or internal liquidity stress test incentivize more banks to utilize the discount window?
So making those changes, particularly the internal liquidity stress test, which isn't something subject to an international agreement or international standard, would send a message to banks that being prepared to borrow from the discount window is something that we see as a tool that you should be using for your liquidity risk management, and would create an incentive for banks to do so. In fact, SVB was looking at the possibility of signing up for the standing repo facility and being prepared to use it, but it learned that wouldn't have actually helped them in the internal liquidity stress test, which then took away that incentive. So it was a real missed opportunity.
Can you quickly tell us how EU countries, the UK or Canada, treat their own discount windows in liquidity stress tests?
So it's quite different. So in the UK, which has much less of a stigma problem, for example, institutions are, they can't change the LCR, but in their own internal liquidity assessments, institutions are encouraged to be planning on using UK facilities. The Bank of England's made repeated public announcements that, that this should be seen as a business decision on the part of banks. They ran tabletop exercises to get the supervisors and the banks together to practice, using the window when it was appropriate to do so. So lots can be done.
Thank you, thank you. I'm concerned that some proposals to change requirements in the pre-positioning collateral of banks at the Fed could tie up capital that could be used for lending to small businesses and families. So on the one hand, you could have had this proposal by the G30 countries, and on the other, the effect of the Basel III Endgame proposal to increase capital requirements. So Mr. Nelson, can you talk about how the lending for small businesses and families would be impacted by the combination of these two proposals?
So it's quite the opposite. It would actually encourage such lending because banks, instead of holding reserve balances or treasuries, which are effectively loans to the government as their source of liquidity, they could be making more loans to small businesses and pledging those to the discount window to get borrowing capacity.
The gentlewoman's time has
Thank you very much.
expired. The chair recognizes the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. Thank the ranking member as well. And of course, I thank the witnesses for appearing today. Is it true that a large number of the depositors at Silicon Valley exceeded the $250,000 FDIC guarantee? Is it true? If so, if you think so, raise your hand, please. Only one person? Only two?
Sorry, say the last part of
The
the question.
depositors at Silicon Valley, is it true that a large number of them exceeded the FDIC $250,000 guarantee?
So 95% of their deposits were uninsured.
95%. Mr. Johnson, do you agree that it was a large number?
It was a large share of the deposits. The number of depositors, I
Well,
can't speak.
all right, let's make it deposits.
Yeah, absolutely. A very, very large share uninsured deposits.
And do you agree that if all of them had been at or under $250,000, the run would not have been precipitated to the same extent that it was?
There's no run. Insured depositors do not run on American banks. That's not something that happens.
And if they don't run when you have your deposit insured, why would you? Your money is going to be accorded you from the FDIC. So if you're not concerned about the run, then the question becomes this: who was responsible for this large amount of people or depositors or deposits being above $250,000? The bank itself is the first line of defense to make sure that you don't have this excess of depositors who are over $250,000. And without the bank's help, you find yourself where we were. I'm not sure that we can blame the regulators for this. Maybe we can find a way to get to them. But that bank had a duty to put itself in a position such that if you have a run, you'll be prepared to take care of your deposit. Mr. Johnson, your thoughts on this?
Yeah, I think, Congressman, you put it very well. I think this was a massive failure of risk management. And the question is, as we've been discussing, how a responsible management should prepare for the eventuality of a run by uninsured deposits. So, for example, you might require, the regulators might require, that, as Dr. Nelson's been saying, that you pledge enough collateral so you can meet all of the runnable, all of the run risk. That's one possibility. But yes, I agree. It's the onus here and the questions here should, in the first instance, and have in the first instance been directed at bank management. What were they thinking?
Yes, and they should suffer consequences. But let's go on to something else. What percentage of banks at $1 billion and under, what percentage of them use the discount window?
I'm sorry, I don't know, and that information is only available with the 2-year lag, but I would say I'd say roughly the same percentage as large banks, which is it's very rarely used these days.
Yes, and because there's a penalty associated with it, it's more likely that it would penalize them greater than it would the big banks. Because a small bank, you're a billion or under, you don't have a lot of margin for error. It's not working? Well, pass him another microphone, please. Thank you, sir. Just be patient. Mr. Chairman, would you give me an additional 30 seconds?
No problem.
All right. If you would, sir, let's hear your thoughts.
So when calibrating the size of the appropriate penalty in 2003, for example, where the goal of the Federal Reserve was to let the interest rate alone be the means by which banks chose on their own to only use the discount window as a backup source of funding, it was really the smaller banks that determined where that rate needed to be, because larger banks have access to money market funds generally at a much lower rate. So the opportunity cost of the other banks is actually higher for smaller banks. So for them, the discount window might be more attractive.
I'm asking because smaller banks, as you know, especially those that are owned by African Americans, and there are very few, they have great difficulty accessing capital from any source, great difficulty. And that I'd like to see the Fed find a way to assist these smaller banks. And if you can, in writing, submit me your thoughts. Thank you, Mr. Chairman.
Gentleman's time's expired. The gentleman from South Carolina, Mr. Timmons, is recognized for 5 minutes.
Thank you, Mr. Chairman. Before we get into today's topic, I can't help but begin by reminding everyone that we wouldn't be here without the reckless spending habits of my colleagues across the aisle, led by President Biden. Their unbridled $7 trillion spending spree led to the highest inflation we've seen in my lifetime, which resulted in increased interest rates. This caused millions of Americans to be priced out of home ownership, grocery bills to nearly double, and ultimately these banks to fail. Whether it's the southern border, the economy, or chaos on the world stage, the policies of this administration are hurting not only American citizens, but the entire world. Now to the topic at hand. In March of 2023, we witnessed the 3 largest bank failures since 2008, when SVB, First Republic, and Signature all were unable to stave off bank runs and ultimately shutter their doors due to poor risk management, concentrated client bases, and in some cases, rapid expansion, all of which were exacerbated by the increased interest rate environment. These banks all tried to work with the Federal Reserve to access emergency forms of capital. However, there were instances where failing banks were met with barriers to emergency funds they really needed as quickly as possible. For instance, Signature Bank attempted to pledge collateral to the discount window, but some of the collateral was encumbered by a Federal Home Loan Bank's super lien, leading to a delay in the bank being able to secure their loan through the discount window. Trying to transfer collateral that had been pledged to an FHLB bank, but not tapped for a loan, over to the Fed's discount window seems to have been clunky and created lags in getting liquidity when time was really of the essence. Dr. Nelson, what can and should the Fed and FHLB do on a more permanent basis to avoid this problem happening again?
So, as I discussed, the Federal Reserve and the Federal Home Loan Banks, for each Federal Home Loan Bank member bank, they work out an agreement in advance over who gets which collateral. But that agreement is complicated by the fact that the Federal Home Loan Banks are secured by a blanket lien on all of the borrowing banks' collateral. So that makes it challenging for the Federal Reserve to get a perfected interest, and why that bank-by-bank agreement is necessary. And so what they do is they pick some type of banks, loans, consumer loans, business loans. They pledge those, and the Federal Home Loan Banks subrogate their interest to the Federal Home Loan Banks. Now, I think a preferable approach may be that the Federal Reserve has a blanket lien and the Federal Home Loan Banks do not, which seems more appropriate for the position of being a lender of last resort for the Federal Reserve, whereas a more normal asset liability management lending on the part of the Federal Home Loan Banks.
How would that policy change be put into effect?
It would require a change in the law.
Okay, thank you. There have been reports that SVB was hit with a bank run and needed liquidity quickly. There may have been lags in obtaining liquidity from the Fed's discount window because SVB had never actually tapped into the discount window and had to navigate the process. Dr. Nelson, again, shouldn't a regional Fed bank, in this case the Federal Reserve Bank of San Francisco, be able to provide emergency assistance to a bank like SVB to quickly show them how to access the discount window?
So they could, and I'm sure that they would. They would have been trying to help the institution. I think the challenges were that the institution didn't have collateral pledged to the window, and that took some time. As Professor Scott has mentioned, some of that had to do with not keeping FedWire open later, but I don't know the details of what went into that decision.
My next question was actually on FedWire. Can you explain what FedWire is and whether the operations of FedWire played a role in the reported clunky attempts of SVB or Signature Bank to get liquidity from the discount window?
So the Federal Reserve, so FedWire is basically, each bank has a deposit at the Fed, and when money is transferred from one bank to the other, the receiving bank's deposit is increased, the providing bank's deposit is reduced. And it's at the core of the entire U.S. payment system. In addition, there's a similar system that transfers book entry securities, Treasury securities, agency MBS, from one bank to another that's also operated by the Federal Reserve. So it was necessary to keep those open later in order for the correspondent bank of SVB to get collateral in. But that wire is normally kept open until 7 p.m. Eastern time, which is standard. But nevertheless, 24/7 would be better if it was possible.
Who has the authority to expand the FedWire window?
The Federal Reserve.
And they can do that without law, just policy change?
As far as I understand, yes.
Okay, thank you. There seems to be a legitimate need for tweaks or reforms to the Fed's liquidity tools, especially the discount window. And I have a couple more questions, but I will send them to you in writing. Thank you so much. I yield back.
Gentleman is yielded. The gentlewoman from Texas, Ms. Dela Cruz, is now recognized for 5 minutes.
Thank you, Mr. Chairman, for holding this hearing, and thank you to the witnesses for being here and appearing before us. Mr. Scott and Mr. Nelson, I have a few questions for the two of you, mainly focused on moral hazard. And my first question is, why are we in the situation where the Federal Reserve has to undertake tremendous interventions in our economy?
This problem of supporting the financial system and the presence of moral hazard have been with us from the time of Alexander Hamilton's establishment of the First National Bank, okay? And there is a trade-off here. The more support that you get from the Fed as the lender of last resort to avoid contagion, which can destroy the economy, okay, the more the potential moral hazard. And so we have to strike a balance, okay, between those two things.
Would you like to weigh in?
I would just add that to some extent, the Federal Reserve has taken actions that have reduced financial market intermediation. So in particular, I'd point to the leverage ratio capital requirement, which treats all assets equally and therefore imposes a high capital requirement on things like treasuries and the tools needed to intermediate in treasury markets. The Federal Reserve fixed that temporarily during COVID, and that helped tremendously. But then once that stopped, the Federal Reserve had to, because of its giant balance sheet, once again increase its reach throughout the financial system. And moreover, the capacity of primary dealers to intermediate has barely changed as the treasury debt has grown substantially, meaning that the ratio has fallen by a quarter over the years. So by those actions have increased the need of the Federal Reserve to intermediate when there are very large flows, say, into the treasury market.
Well, my concern is really that if the Fed's footprint in our economy grows, market actors will come to expect the Fed to step in and bail them out when actors act badly. And so do you expect among the market participants that the Fed will intervene to rescue markets and businesses, increase the potential for systematic financial instability?
So I think we're dealing with the same problem here. So, one thing I think we should explore to alleviate the moral hazard when the Fed acts this way is under, and I stress this, and I put this in my testimony, under appropriate circumstances. We should make those people at the bank who are responsible for triggering this government support responsible in some way. As to a clawback of executive comp. Now, I underline, under appropriate circumstances, because a bank can fail through no fault of an executive or through the fault of executive A and not executive B. So the bill that's out there really doesn't, sort of dealing with this, doesn't get into how do we determine whether somebody should, be responsible for this. But one way to alleviate moral hazard is to make those responsible for the failure of a bank that triggers government response somewhat responsible.
I could add to that?
Yes, yes, sir.
So another thing that's happened since the global financial crisis is that the Fed went from having assets that were 5% of GDP to now they're about 26% of GDP. And they seem to be staying there. And that is largely because the Fed has changed the way it conducts monetary policy. It used to conduct policy by just providing the amount of reserve balances that banks needed. Now it vastly oversupplies that amount. And as it does that, that need gets bigger and bigger and bigger. So that the Fed, whereas before it had a very small footprint in the financial system, now it has a vast footprint in the financial system. And at times, for example, in recent years, half of the assets of money market mutual funds, of government money market mutual funds, were loans to the Federal Reserve System. So by institutionalizing that bigger involvement of the Federal Reserve in the financial system, you're increasing the likelihood that people will come to expect them to solve all problems with their balance sheet.
Thank you. I yield back.
The gentlewoman is yielded. The gentleman from Tennessee, Mr. Ogles, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, witnesses, for being here. I had the opportunity to meet each of you prior to. I think what we've seen over the last few years is the increasing role of government and perhaps the regulatory burden, depending on the agency across the banking and economic sector. Mr. Nelson, under 13.3, there's authorization for the Fed to lend to bank and non-bank institutions under unusual and exigent circumstances as determined by the Board of Governors. Is unusual and exigent circumstances legally defined?
No, not that I know of. It does require the Secretary of Treasury's approval as well.
Mr. Scott, the Fed used Section 13.3 to establish its bank term funding program in response to the bank failure earlier this year. While you question the rationale, the Fed claims that this was partly so that it could value assets at par rather than market value. Is that correct?
That's what the Fed said.
While accounting rules allow banks to value their long-term assets at par on their balance sheets, this is an accounting treatment. It is unlikely, in the event the Fed had to take these assets as collateral, that they would be worth that amount to the Fed. Is that correct?
Yes.
The Fed can't sell these assets at par, can they?
They could not sell them at the market at par, but we should remember that these were hold-to-maturity assets. So under standard accounting, the banks should and did value them at par because they didn't intend them to sell them at par. And if they held them to maturity, they would be worth par.
Right. But seeing how they had to sell them early, then there was a reduction in said value.
If they had sold them earlier, they actually, under our accounting rules, would have been marked down to market. This is why they didn't want to sell them to cover the deposit withdrawal. Better to pledge them to the Fed and get the money from the Fed.
If the bank can solve it, it can access sufficient liquidity without relying on valuations at par. It makes me wonder if this program, the purpose of this program, is there true value in how it's currently structured? What recommendations or tweaks would you make as concerned to valuation, understanding that they may have to be held or they may have to be, departed early?
Congressman, my first point, I'm sorry, it's a little bit hard of hearing.
Yes, sir.
So my first point on this facility is I don't think it should have been used at all. I think the borrowing should have been to the banking system through the discount window, not through this new facility. But I do think this new facility, which valued collateral at par, which was for a year borrowing, which had a very low price to borrow, should be terminated, as is the plan, I think, in March.
Switching gears, Mr. Nelson, when the FDIC was established in 1933, deposit insurance covered up to about $56,000 in today's dollars. Over time, the threshold has increased, market discipline has eroded, and moral hazard has gradually taken hold over the banking system. Does lender of last resort increase moral hazard?
There's a pretty robust debate in the academic literature among economists about whether or not it does. Lending on a secured basis at a penalty rate when you're extending a very safe loan and charging a high rate for it need not create moral hazard any more than receiving a similar loan from a financial institution would. At the same time, if you are able to count on receiving that loan when you're in trouble, potentially, then that can lead to taking activity that isn't appropriately, in which you take on more risk and there is more hazard.
Well, understanding there's a difference between, the small borrower and someone that has assets over $10 billion. And, you take one company in particular that had, worth $13 billion, had 487 in deposits at SVB. I mean, they have an obligation to essentially look at management practices. Wouldn't that be fair?
Absolutely.
Yeah. Mr. Chairman, I'm about out of time. I will yield back.
Gentleman yields back. The gentleman from Florida, Mr. Donalds, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Gentlemen, thanks for coming in. Professor Scott, what concerns do you have about the recent push by the federal government to increase the use of the Fed's discount window more often?
Am I concerned with that? Is that the question?
Yeah, are you concerned, and would you elaborate?
No, I'm not concerned, because I think that the availability, this goes back to Hamilton again, the availability of the discount window and the Fed's ability to lend in a financial crisis to avoid contagion is crucial to our economy, okay? Because an unstemmed contagious run could destroy the financial system and then destroy the economy. So that's why we invented the Fed, to deal with this, okay? So I think the lender of last resort function is essential to the health of the U.S. economy. Every other major country has a central bank that plays a similar function. On the other hand, we have to be cognizant of the problems of having this, which is moral hazard. We have to figure out a way to minimize that and strike the appropriate balance. But I think the Fed has done a good job, generally, in the crisis of using this facility to stem crises. And I think if they hadn't done here, we would have had a lot more hearings on why the economy was in depression, why we were in recession, why didn't the Fed avoid it? So I'm not criticizing the Fed at all for exercising this power.
Let me ask you as a follow-up question, Professor Scott. Do you think that in part the reason why our financial system needs a lender of last resort is because we have various regulatory frameworks in our economy that can inhibit economic expansion or economic stability?
No, I think what happens, you have to, I read a book on this, Connectedness and Contagion, the advertisement.
Right.
But, contagious runs on the financial system are often irrational, okay?
I would
They
argue,
occur because
Professor Scott,
somebody
human
gets
beings tend to do
nothing
that
that
as
the
well.
bank did, but a bank failed and said, oh my God, if this bank fails, every bank's going to fail, I'm getting my money out. And so this kind of, Nobel Prizes have been won by economists talking about this kind of thing. So I think this is not an expansion of the economy that creates this. It's the fear that people have who are depositors in banks, that once a bank fails or a bad situation develops, the financial system's going to fail, they try to get their money out.
But real quick, Professor Scott, let's expound on this thought. So let's go back to 2008. So full disclosure, I was a credit manager, credit officer in banking prior to 2008. I was watching home mortgage underwriting become a flat-out joke as a credit underwriter. As far back as 2004, 2005, 2006, and 2007. Is the cause of the financial crisis of 2008 more about terrible credit quality that was the contagion in lending, or the issue that bank policy writ large was unable to be in the normal deposit-taking and lending function?
Okay, those poor credit policies were probably responsible for the failure of Lehman, okay? But once Lehman failed, okay, a lot of other people who have perfectly good credit policies were experiencing runs on their institutions because people said, well, if Lehman could fail, our bank could fail, or our non-bank could fail, I'm getting my money out. So the contagion part,
right,
the run, really was irrational. Their institutions might have been fine. They don't want to take the chance, get my money out. That's why we need lender of last resort.
Okay. Look, I think one of the things that I think we should try to analyze and really take hold of, especially from the '08 crisis moving forward, is the initial creation of the Federal Reserve. Obviously, there are people who have agreements and disagreements on that, and that's a discussion that's had a lot. Post 2008, the Federal Reserve, none of us can deny, has taken on a much larger portion of our economy that, in my view, is not healthy for a stabilized, growing, organic economic system. It's almost as if we're trying to make sure no problems exist, but then problems exist nonetheless. You think that's a fair characterization?
Yep. My colleague Bill Nelson has talked about the increasing role of the Federal Reserve in our economy. I think that raises a lot of problems that we could have another hearing about. But I think the focus here is, in terms of playing this role of lender of last resort in a financial crisis, I think they play an appropriate role. Whether the Fed should have the involvement in the economy as a whole that they have, I think is a totally different and separate question.
Gentleman's time has expired.
Thank you, Chairman.
I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written requests for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. The hearing is adjourned.
adjourned.